All right, it is 1 o'clock on Friday, December 9th, 2022, and thank you all for joining us here at PayMaster. I'm Rhonda, and I will be talking for about 30 seconds before I hand it over to the wizard of payroll and all things year-end. Just a couple of things real quickly. This is being recorded, so please do not say anything that you don't want to come back to haunt you at a later date. That includes you, Romeo, during the presentation. Also, if you want to change the layout of your screen, there's 3 little dots next to the hang up button. And you can put visual effects, change your background, report a problem, report abuse. That's an important one, especially since Romeo's leading the meeting. And anything that you want to change, you can do that. Also, there's a little hand, and that is not a high five. That is if you have a question to ask. So if you have any questions that you would like to ask, you can actually just hit that little button and we will be checking. In addition, the little chat next to all the little heads to the bottom right. If you'd like to chat with everyone or have a question that you would like to put in chat, go ahead and do so. I would say ideally using chat should be the first choice because then everything's going to one place, but you do you. If you want to raise your hand, go for it. We will not hold that against you. But we truly do appreciate this time that you're spending with us, and we hope that Romeo, is able to bring you some really great information that you can bring back and help throughout the rest of the year. And I want to start with a little song before we get started, just to kick it off because it's that kind of day.
It's a beautiful day in this neighborhood, a beautiful day for a neighbor. Would you be mine? Would you be mine?
All right.
It's a neighborly day.
Oh, it won't turn off. I'm sorry. Okay, anyway.
Can I hit report abuse now?
Okay, without any further ado, Mr. Romeo, take it away.
All right. Thank you, Rhonda. And when it comes to adjusting your screen at the bottom and those 3 dots, if you change layout, you can go to spotlight mode, and that will make my presentation full screen, and you'll see a lot less of the peanut gallery. All right, let me share my screen. There we go. All right, so this is our year-end conference. And as Rhonda said, feel free to post questions throughout the presentation. I will try to monitor that chat. If I think I can answer it and it's applicable there, I'll answer it. Sometimes the answer may be on the next slide, and I'll kind of defer to that. We will post the presentation out to our website. We'll post the recording out there as well. That should be up sometime next week. So if you want to relive this moment again, you can, or share it. I hope to have some time for Q&A at the end. I've run through this a few times now. I've done it in as short as like 35 minutes, and I've done it as long as 55 minutes. So we'll see how I end up today. And of course, these slides, they are for discussion purposes. This is not tax advice. Some of these I am just giving an overview and don't get into details that may be specific to your case. The agenda, what we're going to go over, it's a pretty full agenda on a range of topics on closing out 2022, and then we'll get into a little bit of 2023 information towards the end, and a couple of miscellaneous things. While this presentation is not necessarily geared for PayMaster clients, it's more of a payroll in general. I do want to point out some of our business hours for the coming weeks. Christmas and New Year's Day are on Sundays. The Federal Reserve rule is when a holiday is on a Sunday, banks observe the holiday the next business day. So we are closed the Monday after. The Federal Reserve is closed. We're all closed. And that goes for any payroll service. So if your check date is on Tuesday, you really need to do that payroll the week before. or if your payday is on Monday, of course, you need to do that much earlier the week before to get people paid, prior to that Monday. All right, first up, state unemployment. Any notices you receive from the state or the IRS for that matter, you want to be sure you send it to your payroll service, your payroll specialist. Not all states update payroll service with updated information. A lot of it we rely on you to send it to us. So we'd prefer to just say, send us anything you receive from the state. We are kind of expecting rate increases for unemployment this year or this coming year. And reason being is the state's trust fund pools. This is a historical going back to 2007 for every quarter. And it is how much money states have on reserve in order to pay unemployment claims. And if we look back at the Great Recession back of 2007-8, we saw states deplete their unemployment reserves. They went into the negative. We're going to talk about that in a moment. What happens when states go into the negative? And it was quite a few years before states were able to build up a reserve again, and they did that through increasing tax rates, and we'll see. Coming up into 2019, we were, as a whole, as a nation, in a lot better position. We can, we can see going back to prior to the Great Recession, our reserves are much greater. So when COVID came around in 2020, we dipped down into the negative, but we recovered as a whole pretty quickly after that. So that is a good sign. Except when we look at it on a state level. When we look at each state's reserve, and I believe this was not too long ago, this was pulled. If you can't see across the bottom, we have states like Oregon, Massachusetts, North Carolina. They've got some pretty healthy reserve balances. And unfortunately, we go down to the right side, California, New York, Illinois. These states are in the negative. They ran out of money and they are in the negative. So, and then there's a lot of states that are pretty close to not having sufficient to support another big unemployment claim. So the way states will recover funds is they will increase tax rates. That's why we're expecting some rate increases for 2023. But another way states do it is, I'm not going to say a little sneaky or hidden, is they increase the base the wages are calculated on. So for example, in Florida, unemployment is only paid, the unemployment tax is only paid on the first $7,000 of wages paid to each employee in a calendar year. And once you hit 7,000, you, as an employer, we stop paying tax on that individual. But as we see here, there are many states that are increasing that wage base. Again, Florida's at 7. We should all be sitting, feeling pretty good if you're in Florida. There are states that are many times that. So here, Alaska, Colorado, Hawaii. There are 2 states I put in bold, Missouri and Vermont. If you have employees in those states, they actually decreased their unemployment wage cap. So they must be looking at their pool and thinking that they have sufficient funds to support a next mass wave of unemployment claims. So as a payroll service or any payroll service, we automatically manage these wage caps, but it's just For your reference, if you have employees in any of these states, even if your rate did not go up, you're going to pay more tax because of this. Right. So on the subject of unemployment, there is federal unemployment that all businesses pay. And what's kind of little known about this until it kind of hits you in the face is the unemployment for federal is 6.0%. It is a big percent. And what the federal government does is they give you a 90% discount if you pay unemployment to a state. And so, don't say the government doesn't give you anything. That's, a pretty big discount there. They call it a credit. So that 90% credit translates to you as a business just paying 0.6% for federal unemployment tax. So it's a nice discount. And that's when we talk about unemployment tax, we pretty much just say it's at 0.6%. Now, there is no ability for individuals to file a claim for unemployment with the federal government. So what does the government do with all this money? They stockpile it. And when a state like California or New York goes into the negative, they borrow money from the federal government. They ask for a loan. The federal government expects to be paid back. And there's a 2-year loan, and it's due on November 10th, 2 years after they borrow the money. And the states can pay it back a little bit a month. They can pay it all on November 9th. There's not really a method of how they pay it, just as long as they pay it by that due date. And if they don't, businesses in that state are in jeopardy of losing that discount. So I have the graph in this direction now. We see the states at the top with the most amount of reserves. The states in red have money, but not enough money, according to the federal government, that says, this is what you should have on hand. This list is taken January 1st, 2022. So I would imagine many of these have built up a little bit. And down at the bottom are states that are zero. They have no reserve. They all borrowed money from the federal government, and they all had to pay it back. So New Jersey, Pennsylvania, Connecticut, Minnesota, Colorado, Illinois, California, New York, and the Virgin Islands. So November 10th passed. 2020 was the year that most states borrowed money. And in white are the states that were able to pay back their loan prior to the date. So those states in white are safe. Unfortunately, if you have employees in any of the states in yellow, your state did not pay back money to the federal government, their unemployment loan. So the federal government takes it out on the states and says, all right, if your state is not going to pay us back, you're going to pay us back. And how that's done is a 0.3% of that discount is lost. It's called a credit reduction. And so for California, Connecticut, Illinois, New York, and we'll talk about Virgin Islands, in essence, your 0.6 unemployment tax rate is jumping up to 0.9. You're getting a 50% increase in your unemployment rate to the federal government. This just came out a few weeks ago, and it is retroactive for 2022. So if whatever payroll service you use or PayMaster, the unemployment tax we've been collecting from you and sending to the federal government, it was accurate at that rate of 0.6. Now we have a retroactive 50% increase. This tax is due in January, so we will be sending out a notice to those companies with employees in these states. We'll be collecting that and sending it to the state. So a little bit of historical on this. Every year, a state does not pay back that loan to the federal government by November 10th. So California has until November 10, 2023 to pay back whatever they owe. If they don't, the federal government puts a tax another 0.3% on. So in essence, it will double next year. This is the credit reduction going back to our Great Recession of 2008. So again, kind of a couple of years after, more states during that Great Recession had that penalty, that credit reduction. And we can look at California. So the next year, they 0.6. So the tax rate doubled. 0.9, 1.2. So in this case, your rate tripled for unemployment to the Fed. And it wasn't until 2018 that California was able to fully pay back the loan. So this credit reduction for those states, especially California, New York, it looks like they were the biggest into the red here. California, New York, Illinois may be able to get that paid by the next year. This is going to stick around for quite a little bit. All right, I'm just checking my messages. I don't see any comments yet. So we had that happen to us in Florida back at the Great Recession, but just those states in yellow are this year. All right, moving on to taxable fringe benefits. Our guide is IRS publication 15B. That is kind of everything about fringe benefits, what it is. And in essence, we can summarize it in this one statement. And that is anything you give your employee must be included in their taxable income unless the law specifically excludes it. So anything you give your employee that has a value, unless it's excluded, should be included in their wage. And some of those exclusions, which we'll talk about that first, are employee discounts. Again, the publication 15B will talk about percentages and more details here, but if you give your employee a discount at your shop on a service or a good, that could be excluded up to a certain percentage. And I believe for services, it's 20% of what you would charge a normal customer. For goods, it has to do with the cost of that good. So in essence, if you have a jewelry store and you buy a watch for $500 for your inventory, and you're going to sell that to your employee for $250 for less than you bought it for, then that's just an obvious case of you're discounting it. You're really giving that employee something of value. Employer provided cell phones are excluded. Group term life insurance, if you pay for life insurance for your employees, the first $50,000 of coverage is excluded. There's a whole table on how much to include if you provide life insurance over 50. Of course, any sort of health benefits, dental, vision, that type, you're paying for that. for your employees, sometimes half or all. That's excluded. Dependent care, meals if you furnish it on your business premises. So if you have a large enough business and you have a cafeteria, so if you think of something like Google, they make their campuses with food for employees and gyms and games and things. It all seems nice, but that's just Google's attempt to keep people on their premise, keep them in that work mindset, maybe keep them back at work. So it's for their convenience. And then there's this little catch-all. If what you're giving the employee is so little that it wouldn't be practical. So trying to think of what would be so little. I worked for an employer, 35 years ago, and every Thanksgiving they would give the staff a turkey for Thanksgiving. So I would see that as de minimis. It's a turkey. The value is probably $5 to them, or $7 back then. So that's probably something along that de minimis line. On the inclusions, again, the way it says, anything you give the employee is taxable unless it's excluded. So inclusions is just really everything else. I do highlight a couple here that are popular and maybe abused in some way. And the IRS says, anything that is a cash value, no matter how little, must be included. So that $25 gift card, $50 gift card, a gift certificate, of course, cash equivalent, no matter how little it is, whatever that amount is you give the employee, that needs to be recorded on a payroll. And in our payroll system, or any payroll system out there, we set up a taxable fringe benefit so you can record that a value is given to the employee, so it's properly taxed. Personal use of company vehicle is another big one. If you have a company vehicle and the employee gets to take it home, there may be personal use involved in that, and that needs to be taxable. We typically see this a lot with owners that have the company pay for their car. That your accountant usually determines the value of that to provide to us to record. And that personal use can be done a couple of ways. Again, that publication gives you the methods. There's a per mile method. There's also an actual value method. The other thing that comes up more year end, it's not so much a taxable fringe benefit, but this is something that is taxable. If your business is an S corp and the company pays for health insurance for any owner that is greater than 2%, that insurance is taxable to the employee. So it's called 2% shareholder insurance. It's something that your accountant usually provides. That needs to be provided to the payroll company in order to record and report on the W-2 form. Yeah, so Rhonda wants to know where to buy a $5 turkey. Again, that was 30 years ago. So. All right. Supplemental wages. So the other big thing that comes up at year end are bonuses. IRS Publication 15 is our tax guide, our tax Bible. If there's one document we use in payroll, or that should be used in payroll, is this Publication 15. It's practically everything you need to know. And it defines supplemental wages as anything that's not regular wages. And a regular wage is regular overtime and tips. Anything else is considered supplemental. So bonuses, commissions, vacation pay, back pay, fringe benefits we talked about. All this is supplemental. And the question we're most often asked is about taxes on that. And the IRS says there's two, or in essence, three things you must do. Withhold a flat 22% on that, no matter what the employee's status is, unless they're exempt. If they're exempt, then there's no withholding. But flat 22%, or you include it on the employee's regular check and you let it tax at whatever it taxes at. The third item, which really doesn't come up, is if that supplemental amount is greater than $1 million. In that case, the IRS wants a flat 37%, and that's your option there. Oh, I saw just a question pop up. It's actually on a previous slide. Can the employee deduct the business portion of the miles for a company vehicle, which they are taxed 100%? That's a personal tax question, maybe. So if an employee uses if the employee uses a company vehicle, then they're not paying for that vehicle. The business is paying for it, so there's no deduction for the employee. If they're charged for personal use of that vehicle, then that's personal use of the vehicle, and that can't be deducted on their taxes, because that would be what the IRS would call commuting and personal use. So there is no deduction. All right, so back to supplemental wages. The next question where our payroll specialists are asked is, well, which way is better for the employee? And the answer to that is, we don't know which way is best for the employee. And there is no right answer. There is no answer that's always less. I have an example here where an employee is receiving $1,000 biweekly. That's their salary amount. I think I use single, no dependents or allowances, just single. And their federal income tax calculated to $52. Right, great. This person is going to receive a $500 bonus at year end. So $500, 22% of that, it's 110. If we were to have combined the two on the same check to that employee, so their bonus and their regular on the same check, taxing a $1,500 check is $112. So we can just kind of eyeball this and say, all right, yeah, putting the bonus on the same check would be less withholding than a separate check. Depending on the person's withholding status, depending on how much the bonus is, they could have less withholding on a bonus if it's separate. It's a case-by-case scenario. At the end of the slide, I'm going to show you where on our website we have a lot of resources, but this is a link to our calculators online, and that's where I perform these calculations here. In reality, we get numerous requests from clients that say, I want to give the person $100 bonus and don't withhold any federal tax. I want them to get as much as that as possible, or maybe even I want to gross it up. I want to give the person, it comes out to like $108 approximately, subtract Social Security and Medicare, which is required, and no federal withholding. So they get $100 net pay. That is a common practice. We get requests. We see it all the time. It is, I'm not going to say illegal. It's in violation of IRS withholding. Have I ever seen anyone be penalized or slapped for it? In my 30 years, no, I've never seen it. And if you're talking about bonuses like $50 or $100, it's probably not going to make any waves. If someone's getting a $5,000 bonus or something of a large size, that's going to cause some withholding problems with the employee. They may very likely be under withheld at the end of the year, and that's when something can happen. If an employee is severely under withheld, and maybe they were terminated at some point after the bonus, they're disgruntled, and they owe a lot of taxes on their 1040 at the end of the year, they could be penalized by the IRS for under withholding. And then they're going to report to the IRS, well, it's not my fault I was underreported. My employer did it. I said I was single zero. So that's the scenario where I see it playing out, where you could get in trouble for not withholding. But again, the best practice, do the right thing, withhold taxes, and do one of those two methods. Oh, and Joshua posted a link for a shortcut to our calculators. So paymaster.com/calculators. Right. Talking about some deadlines that we all have to deal with coming up. W-2s, those need to be distributed to your employees by January 31st. That means they must be either handed to the employee or postmarked by that date or made available. ACA forms, we got another extension this year. Those must be distributed to your employees by March 2nd, 2023. That does not mean you should procrastinate in doing your ACA forms. You should do them with the goal of January 31st as well. And then the filing of those forms to the IRS, I'm sorry, to Social Security, is January 31st. And the ACA forms must be filed to the IRS by February 28th if it's on paper, or March 31st if it's e-filed. So again, as a payroll service, we deal with those bottom two dates, the filing. And in order for us to meet that date, which was accelerated from sometime in March, the W-2s a few years ago, we start processing W-2s right after your last payroll in December in order to process the tens of thousands of W-2s. So if your last check date is December 24th, it is very likely Christmas weekend. We are processing W-2s and getting all that done, so we get them into your hands as soon as possible in January, and we get them reconciled and filed to the IRS before that January 31st deadline. We don't want to miss that deadline there. When it comes to W-2s and distribution, the easiest thing to do is for your employees to give an electronic election to receive their W-2 paperless. Social Security says the employee must give consent and display the ability that they can do it. They can't just write it on paper and say, here's my consent. They need to show you they can do it. Within PayMaster HCM, we accomplish that. The screen where the employee views their W-2 is the same screen where we have the electronic consent button. They click that, so we know they got to that screen. They can log in. It's a pretty long consent that SSA requires. And a common question that we're always asked is you receive your W-2 package in January, you rifle through them and you find you're missing a W-2 for John Smith. You call your payroll specialist and you go, John Smith's W-2 is missing. Well, it is most likely, or if not in all cases, John Smith elected to have his W-2 electronic. Within our system, the employees can do that. They're doing it without your knowledge. And any W-2s you may be missing are quite likely because they made that paperless election. I'm not going to go through our system specifics here, but you can ask your payroll specialist how to look at a report to see who has elected paperless. We'll point out that in that large consent the employee signs, part of SSA's requirement is that any electronic consent is void once that employee separates from employment. So once you mark that employee as terminated in our system, you will get a W-2 hard copy for them that will need to be mailed out by that January 31st date. The form itself, there were no changes this year. We've gone through a few years where boxes were changing and the IRS was experimenting with some new fields, but our W-2 form is the same as last year. I did just post to our blog, blog.paymaster.com, our W-2 guide. And it is a kind of a lengthy guide, but it explains every box on the form, how to read it, what's in every box. Because the other call that you're probably receiving from your employees, which gets forwarded to us, is why is my box 1, wages, not my gross pay? It's usually obvious with someone who's salaried, someone who's someone who's $1,000 a week salary. They look at their W-2 and it's not $52,000. It's possible the W-2 could be $53,000. That is because every few years there are 53 weekly payrolls in a year. There's 27 biweekly payrolls in a year. So I don't know if this is one of those years for anyone, but it's quite possible you have more pay periods than you thought. More than likely, the box 1 is less than their wage. So their box 1 could be $46,000, and we get calls and the employee salary is $52,000. Why is their W-2 only 46 or 48 or whatever it is? And they're almost insistent that they want their W-2 to show 52. Sometimes I don't understand why people want to pay more taxes on more wages, but they want it higher. And the reason is pre-tax deductions. They're pre-tax. They reduce your taxable wage. So your $52,000 is reduced by your 401k, your 403b, your simple IRA, your pre-tax health insurance, dental, vision, all of those cafeteria plan deductions, HSA, FSA, they're all going to reduce the amount that's reported in box 1 from the wage. So keep that in mind. You may be able to answer that before forwarding that question onto us. Another thing that we're hitting as a payroll service and filing W-2s to the government is, and not only W-2s, I guess also state unemployment returns, is in the past, the government would just take anything that's on the form. They really didn't have a system in place to validate the filing, and they would just accept everything and deal with problems later. Now states and the IRS, they're rejecting our filings if things are not right. Any SSN that starts with a 9 is not right. Should not be in our payroll system at all. That person is not eligible to work in the US. Social Security numbers that start with a 9 are between the taxpayer and the IRS for filing non-payroll type income. So be sure you don't have any nines. Many states, when we file the W-2s to the state, are rejecting our file. We then have to go back to you as the business to try to find, hopefully, if they have a correct number. More times than not, we find that you've hired someone that's not eligible to work, and we're kind of in a problem where we can't file W-2s for that person, and we need to file W-2s in order to balance. So please make sure there's no nines. You should also do SSN VS, or Social Security Number Verification. You can search for SSN VS out there. It'll go to the Social Security website. As an employer, you set up an account and you can verify Social Security numbers just by typing them in. You put in the name, the number, and you get an immediate result that says if it's a valid match or not. As your payroll service, you have the ability of doing that in our system. It is something you have to request. We will turn it on. There's a small, I think, 50 cents per verification if we do that. All right, so that's enough about W-2s. A little quick thing on 1099s. This is new a couple of years ago. There are now, well, I should say there's multiple 1099s, but there was really only one used for employers, and it was the 1099 miscellaneous. A couple of years ago, the IRS kind of broke it out and made it a 1099 NEC, or non-employee compensation. That's what we default to, non-employee compensation. There may be cases in your environment where you do have to actually issue a 1099 miscellaneous, which is other income, or rents, royalties, the attorney payments, and so forth. So if you need something other than a 1099 NEC, that needs to be kind of specifically stated in our system when that person is paid, what box that goes in, and on which form. So kind of the last form we'll talk about briefly is the ACA 1099, or sorry, 1095 form. It's either the B or the C. And a question we most often get here is kind of like the W-2s, is I did not get a form for every employee. I'm missing one for John Smith. And again, actually the backup for those that are not familiar with this, only applicable large employers, and that definition is if you had more than 50 full-time equivalent employees in the previous calendar year, you have to issue this form for that calendar year. And it reports whether the employee was offered insurance, how much it cost, and if they elected the insurance. So this form is not issued to any employee that always works part-time. Once somebody works full-time for 1 month, this form is required to be given to them. So again, if you have a big company with a lot of transient employees, a lot of part-time, you may not receive this form on every person. And the one key note here is that the 1095-C, kind of this form, is what most employers issue. If your plan is self-insured, and you should know as a business owner, if you are self-insured, you actually have to issue the 1095-B form that lists all the individuals that are covered under that policy. So be sure you let us know if you are self-insured. All right, so I think I've covered kind of 2022 year end. We're now going to talk about some things coming for 2023. We always have limit changes. Social Security wage base is always increased for inflation every year. 2023, it was published 160,200. Our 401ks are going up this year, so the maximum contribution 22.5. Catch-up went up, and so between the two, the maximum for someone 50 and over is $30,000 into their 401k. IRAs increased to 6,005. Health savings account between the employee and employer, this has gone up to $3,850 for someone who's single, and anything other than single, the maximum HSA contribution is $7,750. Catch-up is remaining the same on the HSA. And FSA is going up to 30,000 or 3,050. Minimum wage, it is still going up. 26 states have increased their minimum wage for 2023. Most are January 1st effective dates. For Florida, it's September 30th. I think New York is like December 31st. So there are some oddballs out there. I don't want to put every list out here because there are hundreds. So between the states that increased, there's many cities, counties, localities that have also implemented their own minimum wage. I noted the highest one out there is SeaTac, Washington. It's $19.06 an hour. I think Seattle is just below 19. It's the almost 19. And on the opposite end of that, 20 states have not changed their minimum wage or don't have a minimum wage, and we're at the federal minimum wage of $4.25 an hour. If you have employees in other states, you can go to blog.paymaster.com. The second blog on there is a list of all the states that have posted. All right. W-4s, this is another question that comes up often is, does the employee need to fill out a new W-4 each year? They sort of don't, except for any employee who claimed exempt on their W-4 for this current year. Someone who claims exempt needs to fill out a new W-4 each year. Otherwise, they should lose their exemption. And speaking for our payroll system, and as far as any other payroll system I know out there, no payroll system will automatically revert someone to lose that exemption on January 1st. This is something that you have to do manually. Again, if you're a PayMaster client, you can check with your payroll specialist. We can tell you what report to run if you're not sure, to show who's claiming exempt. But anyone who's exempt, you need to change them to single zero, effective with the first check date in January, and they need to give you a new form. And what I suggest is, everyone should fill out a new W-4 each year. Things change in their personal life. The IRS, this is their shortcut, irs.gov W-4 app. That is a tax withholding calculator. It's an interactive question and answer session. The employee goes there. and they will answer a lot of questions. And at the end of it, the IRS will fill out a W-4 for them. They'll say, here's your W-4, print this, give it to your employer. And it tells them exactly how to complete that. And why it's so important these days is this. I found the tax withholding tables going back to 1988. I did this 4 years ago. And I calculated, I was just curious. I guess I was bored. I calculated the federal income tax withheld, because we always hear about taxes going up and paying more in taxes. I'm like, is that really true? I took $500 of weekly wage, and someone who is single one and married one. So the red line, if you were single one in 1988 earning $500, you would have had about $82 withheld from your check just for federal. In 2018, you're about $38, so less than half. And here's the big one. In I think this was 2022, it's like $28 of the same 500. And at first I was thinking, well, okay, the value of money or something like that, but I'm still using $500 in taxable wage. So the relative percent, your taxes has gone down drastically. And for married and one, you're practically nothing. So the reason for this in 2020 or 2019 is government wanted to put more money in the employee's hands on a per payroll basis. They wanted them to pay less withholding on their check and have a lesser refund at the end of the year. And that means that the withholding is very close. So you want to make sure that their withholding is accurate. The next biggest thing or pitfall that I see occur is the W-4 form. It is set up for failure to under withheld the employees. It's kind of bad form design, but it is what it is. And here is the catch. On the W-4, you give this to an employee. They're not used to reading government forms. They see their name at the top, and then the next box is single, married, head of household. Right? They check that, and then they get to section 2. And step 2 is a whole lot of writing, and I guarantee nobody is reading any of this. They see a lot of writing, and they throw their arms up and they sign it and they go, "I'm done." Well, all this writing is important, and they hide this little checkbox among all this writing. I wish there was a big red arrow on the form. And then employee not checking that box when they're supposed to, they could easily be $800 under withheld at the end of the year, if not more. The pitfall on that form, that checkbox, is if that person works multiple jobs, or if they're married and the spouse works, those are 2 definite cases that box needs to be checked. And in January, February, I'm sure we will get calls into our office that will say, "Why is John Smith's withholding so low? Why he did his taxes and he owes $1,000. What did you do? What did your system do wrong?" And guaranteed, it comes up. We pull up the employee's file. The first thing we usually see is John Smith selected, married, filing jointly as its withholding status. We look to see if this box was checked in our system. It was not, and that's where his failure took place. So, as a payroll administrator, when you receive these forms in, you should see if they selected married jointly, and then see if they check that box. If they didn't, you quite possibly will be saving that employee some problems when they go to file their taxes. I think it was a Forbes article I saw 3 days ago. I think it was on Wednesday, actually. And it said many taxpayers are going to be for a surprise this year when they file their 1040, that they're going to be short. And I was curious. I read through it. And what the article was saying is the child tax credit drastically reduced. There's no subsidy in 2022, right? 2021, we received that recovery rebate, $1,400 a person in 2020. We had other stimulus checks that came in. So 2022, there's a lot of changes, and we're probably going to see it more than ever that people are under withheld in taxes when they file, and that box could be the saving piece of that. And Adrian pointed out if an employee states exempt on the W-4, it's kind of a weird language in payroll systems. In payroll systems, we use the term exempt and block. And the IRS uses the word exempt. Exempt from withholding means to block withholding tax. It doesn't mean the employee is exempt. When you say exempt from tax, the system will not only not withhold the tax, but it pretty much won't give them a W-2 form to report any wage. So be sure when you have someone exempt and you put it in your payroll system, you indicate it as block. So I know I'm getting close on time. The last two things are not necessarily driven for any particular year. This is something that I see way too much of. It is it's called direct deposit diversion fraud. This is fraud that I can teach a 10-year-old how to do it in probably about 5 or 10 minutes. This time of the year, you're buying gift cards off the rack. And some of you may have purchased these on the rack in 7-Eleven, Walmart, your CVS. In between those gift cards, there are these reloadable cards. American Express, Green Dot, Chime. There are many of them. Square. These are, in essence, bank accounts you can buy. Looks like for $1.95 for American Express. You buy one of these cards off the shelf. You open up the wrapper, and you have a direct deposit account number and a routing number. It does not take much to activate one of those accounts fraudulently. I've done it myself to test it out, and I was able to activate a card. I bought a Green Dot card. It cost me $4.95 to do it. What the criminal does, the fraudster does, is now that they have a bank account number, they're going to try to get that into a payroll system. And the way they do that is so easy as well. I know many of you have beautiful websites and you like to show off. Here's our staff. Here's our executive board. Here's our customer service reps. That is wonderful. It's nice to have, but that is also wonderful for criminals. It doesn't take much beyond that to social engineer what they need to do. We had a case 2 weeks ago, and I went to the company's website, and here's what I found. It had the president of the company, it had the office manager, and it had her picture, and it said, she's our office manager and she handles this, and here's her email address, and then here's our 10 employees that work in the company, and here's their picture, a little bio, their email. What the criminal does: set up a Gmail account, pick any random employee, you can create a variation of that person's name with a Gmail account. Maybe it's john.smith or john.smith99 or something like that. Send an email to the office manager. That must be the person who handles the payroll. Send them an email. Hey, Mary, I want to change my direct deposit account, and I had to close my other one. I had some fraud on it. Can you make sure this direct deposit account goes live for the next payroll? And Mary sends back, sure, John, I'll get that right in for you. Or maybe here, fill out this form. I've seen criminals fill out forms, say whatever they need to say to get that office manager, that payroll administrator to take the bait, to change it. You change the direct deposit account number, payday comes around, the criminal is sitting there waiting for that fund to show up. They hit the ATM, they will never be caught. The employee will then call you and say, hey, I thought today was payday. I didn't see my money in my account. And then you say, John, do you remember you changed your bank account? And that's when John says, what changed? So that is what transpires. We see this way too much, practically weekly. So please, the best way to catch this is whenever you receive any direct deposit change in a format that is not the employee handing it to you in person, is to call that employee, say, hey, John, I just received your email with your direct deposit change. Is this your intent to change it to this? Get that verbal confirmation. That is going to save you eventually, because it's just we're just finding this running rampant. There are some cards out there that criminals love. It is American Express and Green Dot. There are a few others. When we see those accounts hit our system, we'll try to reach out to you and give you a heads up, but we should be a last resort. Green Dot has like 10 routing numbers, and I wouldn't be surprised if they add another one. So we're not going to be perfect in 100% identifying that something is a pay card or something looks fishy. So please do that verbal confirmation with your employees of any change. Lastly, employee retention credit. This has been around for a while. You may see email solicitations from other companies. It is a great benefit. Some people think it's too good to be true. The government giving out free money. It's really not. If you think of it, there was 2 rounds of PPP where the government was giving out free money. So this is just another means of the government helping businesses affected. If your business had a 50% drop in revenue in any quarter in 2020 compared to 2019, or greater than 20% drop in the first 3 quarters of 2021 compared to 2019, you could qualify. There are some other qualifications to this, but revenue is one method. Or, and it is an either or, it doesn't have to be both, or if your business had a disruption due to a government order. So if the government told you you can't do something in 2020 or 2021 that you were able to do prior, then you may be eligible. So if you do have either of these situations, you can reach out to us. I'm happy to discuss that further with you. All right, where are we on time? All right, we're coming up on my hour or close to it. A couple of resources I just wanted to point out. If you go to our website, paymaster.com, there's a link at the top of the screen for resources. If you click that, there's a link to our blog that I've mentioned a few times. The conference archive, which is where this webinar is going to be posted next week. Forms, there's all sorts of forms. We'll have the 2023 W-4 posted out there, and other publications. The payroll calculators, that's where I did the calculations, our mobile app link, our holidays, so newsletter archive. So all those are out there under our resources for you. All right, and that is my end of the formal part of the presentation.
Before we get into any questions, I want to circle back to the Employee Retention Credit Act for a moment, if I could. In the evenings, I'm seeing a lot of commercials about, we can help you get money back from the IRS that you lost during the pandemic. Call us at. So there's a lot of predatory companies out there right now. They don't talk about the fact that it is the Employee Retention Credit Act, but that is what, in fact, they are advertising. I've actually called a couple of them just to see what they're doing. Most of them are charging upwards of a 30% contingency fee, and they are only looking at the surface level of things. So if you get any type of solicitation like that, you see something on TV, you're feeling weak, you're like, I really could use this money, I would caution you to stay away from companies like that. Reach out to Romeo if you have any questions, or myself. But people like to prey on people's hardships, and these companies are popping up all over the place. So I just wanted to note that.
Yeah, and I'm happy to give a second opinion, and you should get a second opinion. There are companies that I've been referred to, and they were told that they were not eligible. I look at it and they're eligible. And the other way around, there's companies that came to me and said, hey, I'm eligible, I need this filed. And I let them know there is no way you're eligible based on these qualifications. And so there are some gray areas, and it's namely in that bottom one, your disruption of business. The IRS is very specific as to what is a disruption of business. I am doing a presentation for the Florida Institute of CPAs to hundreds of CPAs throughout the state of Florida next week. And I'm doing an hour-long presentation just on this to educate CPAs. So this is a very detailed topic, but I just wanted to throw this out there as a quick little thing if anyone has any questions.
Going once.
Going once. It's too late to report me for abuse. You've already sat through the.
No, you can still do that. I'll give you 10 more seconds if you want to hit that. No, we want to thank all of you. First of all, we appreciate you as our clients, not only for allowing us to take care of your business needs and your payroll, but also for enduring the likes of Romeo and I once every quarter. So thank you for that. Reach out to us with any questions, any concerns that you have. And most of all, just have a very safe, beautiful, and loving holiday with your family and friends. And let's hope that 2023 is the year of the normal. How's that? That'll be the normal year. We're gonna start a normal year in 2020. That's my goal. That's my little wish for all of you.
All right. So happy normal 2023. We'll close with that.
Okay. Everybody have a great day, and just take care of yourselves.
All right.
Bye-bye.
Bye, everyone.
All right, thank you.